Today, we will discuss an issue that's facing taxpayers and government workers across the state, and that is the unfunded pension liabilities of their state system. Last week, my organization, the American Legislative Exchange Council, released our annual report, Unaccountable and Unaffordable. In its 7th edition, this report analyzed the unfunded pension liabilities for each and every state across America. And this year, those unfunded liabilities total nearly $7 trillion nationwide, which, of course, is an average of nearly $21,000 for every man, woman, and child in America. This issue of unfunded liabilities flies under the radar for most Americans, unfortunately, as we don't get a bill in the mail stating how much we must pay into the public pension fund. Instead, these unfunded liabilities take up a large amount of our tax dollars within state and local budgets, crowding out funding for essential public services and taking away opportunities for future tax relief. All 50 states have massive unfunded liabilities. The 5 states with the largest unfunded liabilities, however, are Connecticut, California, Hawaii, Illinois, and 50th out of 50, Alaska, ranging from anywhere from $34,000 per person upwards of $46,000 in Alaska. So these are truly massive numbers, our study revealed. Ultimately, states are in dire need of pension reform. So how did we get here? In addition to many of the significant policy challenges to government pension systems, such as state governments underfunding the systems and some big government politicians overpromising generous new benefits, a large and growing threat to pension plans and taxpayers is politically motivated investment schemes. Politically driven investments have been around for decades, but until recently, they haven't really taken on a level of prominence that they needed to be exposed in the form of an acronym that many of us have heard of that recently has become mainstream news. And that is thanks to the efforts of ALEC lawmakers and state financial officers across the nation to expose it, to it there being so-called environmental, social, and governance investing, or ESG investing. ESG, like previous iterations of politically motivated investing, has been around for some time, but has been used to punish politically, quote-unquote, unfavorable companies and industries by divesting from them. These strategies reduce investment returns over the long term, which leads to underfunding in the state pension plans across the country, with taxpayers ultimately footing the bill for these shortfalls. California, once again, playing the role of a state that always seems to show us what not to do, has left billions of dollars on the table in foregone investment returns thanks to politically motivated investment fads, like divesting their funds away from tobacco stocks more than 20 years ago. However, just because you may live in a state other than California, it doesn't mean your pension fund is safe from ESG and politically motivated investing. The largest of the proxy advisory firms, which guide institutional investors on how they should vote in corporate shareholder meetings, for instance, have increasingly pushed politically driven goals. One infamous case occurred recently over a proxy fight to replace 4 board members of ExxonMobil with Green New Deal-style activists, against the wishes of the company, of course. Institutional Shared Services, known by its acronym ISS, used its position as a proxy advisory firm to the Employees Retirement System of Texas and the Teachers Retirement System of Texas to recommend the pension systems vote in favor of replacing the board members at ExxonMobil. The systems both followed the recommendations of ISS, and 3 of the 4 board members of ExxonMobil were replaced by the Green New Deal-style anti-energy activists. And if this can happen with progressive anti-energy efforts in Texas, of all places, it can happen anywhere. To address these politically driven efforts that threaten pensions across the nation, a new ALEC piece of model policy was just released, the State Government Employee Retirement Protection Act. This model strengthens what we call fiduciary rules to keep politics out of pensions, requiring plan managers and proxy advisors alike to make decisions solely in the interest of financial returns for the retirees. Thankfully, in an incredible breakthrough, a dozen states now have passed legislation based on this ALEC model in 2023 alone, protecting retirees and taxpayers alike. Several states are also leading the charge on sound, broad pension reform. This year, North Dakota passed legislation that will enroll new hires in a portable, flexible, defined contribution pension system, just like the 401ks nearly all of us in the private sector use. North Dakota joins Alaska, Michigan, and Oklahoma by switching to a full defined contribution public retirement system for new workers, while honoring the promises made to current employees and retirees. With major pension reforms to protect against politically weaponized and chronically underperforming pensions, states continue to show that tackling big policy issues can be done successfully with real leadership, and it brings about the trusted policy solutions that we in ALEC continue to provide for all Americans. For more information, visit alec.org. For American Radio Journal, I'm Jonathan Williams. Thanks for listening.